What if I told you the most underestimated metal in the global financial system just crossed a line it was never meant to cross, not quietly, not gradually, but decisively? Silver at $59 is not a headline, it's a signal. A signal that the old models, the linear forecasts, the comfortable assumptions about value are breaking down in real time. For decades, silver was boxed in, treated as a sidekick to gold, a hedge, a footnote, a trade, never the main story. Analysts built ceilings for it, investors built narratives around why it couldn't happen, and markets believed those narratives because they were anchored in the past, but innovation doesn't respect historical ranges. And scarcity doesn't care about consensus. This move didn't come from speculation alone. It came from fundamentals colliding with reality. Silver sits at the intersection of two unstoppable forces: monetary trust erosion and exponential technological demand. On one side, global debt levels are redefining what sound money even means. On the other, silver is becoming non-negotiable for the technologies shaping the next decade: solar energy, electrification, data centers, artificial intelligence, advanced electronics. This isn't cyclical demand, this is structural. Every solar panel needs silver, every electric vehicle needs silver, every high-performance circuit relies on silver's unmatched conductivity. And unlike software, you can't scale silver production with code. Mining is slow, capital intensive, and constrained. Supply hasn't just failed to keep up, it's fallen behind year after year. That gap doesn't close easily, it compounds. What surprised the world isn't that silver rose, it's how violently it repriced once the market realized the inventory simply wasn't there. When a market discovers that something assumed to be abundant is actually scarce, price doesn't adjust politely. It leaps, and that's what $59 represents, a repricing of reality. The most fascinating part: this happened while attention was elsewhere. While headlines chased short-term narratives, silver quietly absorbed pressure from every direction. Industrial users locked in supply, investors reevaluated hard assets, currency volatility pushed capital toward things that can't be printed. And suddenly, the market woke up to a truth it had ignored for years. This is how disruption looks in financial markets: not loud at first, not obvious, then all at once. People will ask if this is the top. That question misunderstands the nature of what's happening. Tops are formed in euphoria, when participation is universal and belief is unquestioned. That's not this environment. This is still disbelief, still surprise. Still analysts scrambling to update models that never accounted for a world where silver is strategically critical. And here's the uncomfortable part: once a metal proves it can break decades-long constraints, it changes behavior. Producers rethink contracts, governments rethink reserves, investors rethink allocations. The psychological ceiling is gone. That doesn't guarantee straight line moves, but it permanently alters the range of what's possible. Silver at $59 is not about silver alone. It's about how quickly markets can shift when innovation, scarcity, and macro pressure align. It's about what happens when the future demands more of a resource than the past prepared for. And it's a reminder that the biggest moves never feel obvious until after they happen. This was never supposed to happen according to the old playbook. But the old playbook was written for a different world. Silver just crossed $59, and what's remarkable isn't only the price, it's the silence. Wall Street didn't ring bells. Strategists didn't crowd the airwaves. There was no coordinated narrative to explain it away. And that's exactly how the most important market shifts usually begin: unnoticed, underappreciated, and deeply misunderstood. For years, silver lived in the shadow of gold. It was treated as a tactical trade, a volatility play, a metal you owned briefly and exited quickly. Models capped its upside, forecasts recycled the same assumptions, and institutions grew comfortable believing silver had a ceiling. But markets don't move based on comfort, they move based on reality, and reality has changed. This price move didn't come from hype, It came from pressure, relentless, compounding pressure building beneath the surface. Silver is no longer just a monetary metal. It's becoming a strategic input for the global economy's next phase. Electrification, renewable energy, automation, artificial intelligence, DAI. To infrastructure, all of these trends rely on one physical truth. Silver's conductivity cannot be replaced at scale. You can innovate around software bottlenecks. You cannot code your way around atomic properties. At the same time, supply has been quietly tightening, mining production has struggled to grow, new discoveries are rare, existing mines face higher costs, regulatory friction, and declining ore grades. Silver isn't mined because demand suddenly spikes. It's mined years in advance, based on long-term expectations that were wildly underestimated. When demand accelerates faster than supply can respond, markets don't adjust gradually. They gap. Wall Street missed this because it was looking backward. It was anchored to decades of price behavior that belonged to a different economic regime, a regime with lower debt, slower technological adoption, and less systemic fragility. Today's environment is fundamentally different. Global balance sheets are stretched, currency confidence is fragile, and capital is searching for assets that sit outside financial engineering. Silver fits that moment perfectly. It is tangible, scarce, and increasingly essential. That combination is rare, and when the market finally begins to recognize it, repricing happens fast. What's even more telling is who drove this move. Not retail speculation, not social media excitement, but industrial demand locking in supply, long-term investors repositioning quietly, capital moving before headlines. This is not a late cycle blow-off. This is early recognition. There's a misconception that markets are efficient in real time. They're not. They're efficient in hindsight. By the time a narrative becomes consensus, the opportunity has already shifted. Silver at $59 isn't the end of a story, it's the market admitting it got something wrong. Once that admission happens, behavior changes, risk models are updated, portfolio allocations are reconsidered, strategic stockpiles are discussed, and suddenly an asset that was ignored becomes unavoidable. That's when volatility increases, not because the story is weak, but because conviction is still forming. The most important question now isn't why silver reached this level. It's why it took so long. The ingredients have been in place for years: structural deficits, exponential demand curves, and macro conditions that favor real assets. What changed is awareness, and awareness always lags reality. Wall Street didn't miss this because it's incompetent. It missed it because disruption rarely looks disruptive until after it's underway. Silver didn't send a press release. It simply responded to forces bigger than forecasts. And as those forces continue to build, the real surprise may not be that silver hit 59, but that so many people still think that's the story. No one saw $59 silver coming, and that blind spot tells us far more than the price itself. Markets are very good at extrapolating the past and very bad at recognizing inflection points. This move wasn't priced in because it didn't fit the old framework. Silver was supposed to be slow, cyclical, range-bound. Instead, it behaved like an asset sitting at the center of multiple exponential forces converging at once. For years, silver was misunderstood because it was miscategorized. It wasn't treated as strategic. It wasn't treated as essential. It was treated as optional. That assumption is now collapsing. Silver is not just a precious metal tied to sentiment or inflation hedging. It is an enabling material for the next generation of economic infrastructure. When the world commits to electrification, decarbonization, automation, and data intensity, it implicitly commits to silver. This is where linear thinking breaks. Demand for silver is no longer driven primarily by jewelry or coins. It's driven by systems. Solar panels don't scale gradually. They scale exponentially once adoption crosses cost thresholds. Electric vehicles don't add incremental ounces, they embed silver into millions of units at once. Data centers, AI hardware, advanced electronics all depend on silver's unmatched conductivity and reliability. These are not discretionary uses, they are foundational. At the same time, supply is structurally constrained. Silver mining is not a growth industry. New mines take years, sometimes decades, to develop. Many silver ounces are byproducts of other metals, which means production doesn't respond directly to silver prices. Even when prices rise, supply doesn't surge. That disconnect is critical. It means demand shocks don't get smoothed out, they get amplified through price. So when silver moved to $59, it wasn't a surprise because of speculation. It was a surprise because the market finally acknowledged a mismatch that had been building quietly for years. Inventories tightened, industrial buyers secured long-term contracts. Investors began to reassess what scarcity actually means in a world built on physical inputs. This changes everything because it resets expectations. Once an asset breaks through levels that were considered impossible, the psychological framework shifts. Risk models change, portfolio construction changes, strategic behavior changes. Silver is no longer something you ignore until inflation spikes. It becomes something you study because it sits at the crossroads of innovation and constraint. What makes this moment so powerful is that belief still hasn't caught up. There is no universal consensus. There is no euphoric participation. There is confusion, skepticism, debate. That's exactly what early-stage repricing looks like. The biggest moves don't happen when everyone agrees. They happen when reality forces a reassessment faster than narratives can adapt. This also exposes a deeper truth about markets today. Traditional valuation models struggle when assets are tied to exponential adoption curves. They assume mean reversion, they assume substitution, but some materials are not easily replaced, and some demand curves don't flatten, they accelerate. Silver is revealing that mismatch in real time. $59 is not a finish line. It's a signal that the market is waking up to how the future is actually being built, and when markets wake up late, they tend to move fast. What was invisible suddenly becomes unavoidable. What was dismissed becomes debated, and what was ignored becomes essential. That's why no one saw it coming, and why its implications reach far beyond a single price print. $59 silver is now confirmed, and the most important part of that statement isn't the number, it's the confirmation. Markets are full of false starts, short squeezes, and temporary spikes. This wasn't one of them. This was an awakening. An asset long dismissed, undermodeled, and underowned just forced its way back into relevance, and it did so without asking for permission. Silver has spent years being ignored because it didn't fit neatly into institutional narratives. It wasn't flashy enough for momentum chasers, and it wasn't static enough for traditional hedging frameworks. It sat in between misunderstood, underappreciated, and mispriced. But markets don't reward attention, they reward necessity. And silver has quietly become necessary. This confirmation didn't come from enthusiasm, it came from inevitability. Industrial demand didn't ask whether silver was cheap or expensive, it asked whether it was available. Energy transitions, electrification, automation, and data infrastructure don't negotiate with supply constraints. They consume what works, and silver works better than anything else when conductivity, efficiency, and reliability matter at scale. The old belief was that higher prices would quickly bring new supply online. That belief is now being challenged. Silver mining is slow, capital intensive, and increasingly constrained by geology, regulation, and cost inflation. Much of global silver production is tied to other metals, meaning output doesn't rise simply because silver prices do. This creates a lag that markets consistently underestimate. When demand accelerates faster than supply can respond, price becomes the release valve. What's striking about this moment is how few people were positioned for it. The asset was ignored because it didn't move until it did. That's often how structural shifts begin. The absence of attention allows imbalances to grow larger than expected. When the adjustment finally arrives, it feels sudden, even though it was years in the making. Silver waking up also exposes a broader flaw in how markets evaluate value today. Too much focus is placed on financial abstraction and not enough on physical constraint. Digital systems scale fast, but they still rely on atoms. Chips, panels, batteries, networks, all of them require real materials. When those materials are scarce, strategically important, and difficult to replace, their value behaves differently than traditional commodities. This move confirms that silver is no longer just a tactical trade. It's becoming a strategic asset, not because it's trendy, but because it sits at the intersection of innovation and limitation. That intersection is where repricing happens most violently. Once markets accept that an asset is essential rather than optional, its role changes permanently. What makes this especially powerful is the stage we're in. This is not widespread excitement. This is recalibration. Analysts are revisiting assumptions. Allocators are questioning weightings. Industrial users are thinking longer term. These are quiet shifts, but they're foundational. Loud moves come later. There's also a psychological element that can't be ignored. Once an asset proves it can break through levels that defined its identity for decades, the mental ceiling disappears. Even pullbacks are viewed differently. Volatility doesn't signal weakness, it signals discovery. The market is learning in real time how to price something it previously misunderstood. Silver didn't change overnight, the world around it did, and the market is just beginning to reflect that change. Confirmation at $59 isn't about validation, it's about recognition. Recognition that the ignored asset wasn't dormant, it was building pressure, and when pressure finally releases, it rarely does so quietly.